Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX, coming to you from the trading floor this morning on April 25th. It's a Friday, a little before 9 a.m., and taking a look at the commodity markets this morning as we're seeing crude oil prices kind of pull back a little bit, consolidating lower. Same thing with gold prices after nearly hitting $3,500 previous days as uncertainty had really peaked, at least for the time being in this market, some profit taking going on there. As we look at the grain and oil seeds, generally mixed. They found some support overnight, and we're going to kind of talk about that this morning a little bit more. And that's some early signs that we may be some de-escalation or some thawing in the relationships between the United States and China. Now, that still leaves us a long ways away from an agreement. Now, it started with the White House talking of possibly cutting tariffs in half by members of the cabinet, making statements along that line. But that was kind of a theoretical thing if the trade talks were to start or something like that, apparently, because President Trump certainly denied that he had done so or was planning to do so imminently. Members of the Trump cabinet also spoke of the need to de-escalate, saying that the current tensions were unsustainable. President Trump has told reporters that President Xi Jinping of China has called, but that was not a sign of weakness by any means on his part, that he's a strong leader. He has respect for him. On the other hand, China kind of just says, hey, there's no formal discussions going on. I think both are kind of probably true. I think there are talks going on at various levels, but China considers formal negotiations to be face to face talks, and they don't want to look weak. I think it's important, again, as I said yesterday, to keep in mind that China has been communicating the message to their people that it's the United States that has the unfair trade practices. It's the United States that's been the bully in the room, so to speak. And we need to sacrifice in order to stand up to the United States. And that's created a great sense of nationalism that has really elevated Xi Jinping's popularity in China. So if he looks weak in a negotiating stance, then he could lose some of that popularity. So in essence, if these are going to start, there has to be a way to allow him to continue to look strong, giving him a way out. And the same is true to some extent with President Trump. Neither of these leaders face an election coming up. President Trump is serving in his second and final term. Xi Jinping can be in president as long as he wants, so to speak. But that doesn't mean that they're exempt from the support of the people, so to speak. Xi Jinping always has to worry about what could happen to overthrow him in China, although that would be somewhat challenging to do. It would have to probably come from within the party, but nevertheless, he's still going to be concerned about maintaining the support of his people. President Trump has to worry about maintaining support of Congress so that Congress doesn't clip his wings and not allow him to continue on in this tariff battle. And so both of them have to have those concerns. So from that standpoint, this is unsustainable. There has to be a way that both can find their way out, and it looks like they're finding that way now. Now, today we learned that China is actually exempting some products from their 125% retaliatory tariffs. They haven't made any public statement about it, but some U.S. suppliers have been privately notified this is true. What we've heard is ethane, for example, essential medical supplies, aircraft. Many airlines lease equipment and rather than own it themselves, and so apparently some exemptions there. And this shows that China is willing to exempt those items that they can't find anywhere else that's really going to hurt their economy the most. And we saw this during Trump 1.0 as well, when they even exempted soybeans. So we've had a lot of worries about soybeans losing the China market, and I've emphasized how we're losing the China market anyway due to ever expanding production in Brazil that's increasing the supply there, and due to currency exchange rates, those are going to be cheaper than those from the United States. So we have been losing market share, and that will likely continue to be the case. However, when Brazil runs out, when the shelves run empty, the bins run empty in Brazil, China comes to the United States if it can't get what it needs from Argentina. and that will continue to be the case until Brazil simply produces everything that China needs. And of course, China is taking steps to reduce what they need as well. But nonetheless, when China needs something, it will find a way to get it. And that is, we're starting to see those signs of that now starting to play out. Now, it's interesting, and I wrote about this in my commentary this morning. Goldman Sachs surveyed 46 enterprises whose products comprise 70% of China's export value to the United States, basically asking them if the tariffs had severely impacted, or only slightly impacted their ability to move those products. The survey found that 60%, back up, revealed that 41% of the products had been severely impacted, 36% merely impacted, and 23% slimly impacted. It revealed that 60% of Chinese producers are negotiating prices with U.S. buyers to consider passing or sharing the tariff burdens. U.S. importers are said to be placing orders from alternative sources, mainly in Southeast China, Mexico, and India, to fill the gap. Now, the survey also suggests that they should be able to maintain a stable supply for most products, although there may be some shortages and empty shelves in the U.S. Most major suppliers keep a 2 to 6 month supply. That provides some buffer to allow them to get alternative supplies, but smaller independent suppliers may not be able to do that. As such, they may see some shortages. Now, Chinese shipping data suggests that demand for containers, over which much of these supplies are shipped, moving from China to the United States, increased 10% year on year in the first quarter of this year, ahead of the reciprocal tariffs, preparing for them, getting stocked up. But they're expected to fall by 15% in the second quarter and fall by 27% on the year in the third quarter if this trade war continues. Now, in the end, again, it comes down to who loses the most political capital first, Xi Jinping or Donald Trump. Neither face an election, as I indicated. Now, for his part, Trump needs to start producing some hard evidence of progress that his strategy is working. We've heard rumors of we're close to an agreement with Japan. We're close to an agreement with this country, that country. Now the word is we're very close to an agreement with India. Will he be able to push one of these over the finish line? If so, that could be very significant, not only for demand for commodities, depending on which country it is, um, but also for maintaining the support of the consumer here in the United States, and therefore of Congress here in the United States, to continue to apply pressure on China. And so he needs to see some of these wins very soon to keep that momentum going. Now, we did see some strength in the soybean complex. In fact, we saw some strength, modest strength in the grain and oilseed complex overnight on these signs of thawing of relationships with China. But I want to point specifically to the soy oil market, which saw prices rise to their highest levels since December of 2023, which also provided some support to soybean prices, which rose to their highest level in over 2 months, on hopes, chatter in the marketplace that the EPA in the United States could release its updated mandate for biomass diesel production maybe as early as today. We have been thinking that it happened sometime in May. The industry generally expects it to happen by Memorial Day, but we have to respect the chatter that's in the marketplace that it could happen this week, and we're now down to the end of the week. So if it doesn't, there could be some disappointment, but what will that number be? The industry has recommended to the EPA 5.25 billion gallons, up from 3.35 billion gallons currently. That would be a huge increase. That would be very supportive of the industry. We felt like if they followed their old modeling techniques, that it would be 4.25 to maybe 4.5, although we're seeing some indication now that they may throw some more support to the ag industry and to the biofuel industry, change that formula, and it may be closer to 5 billion gallons, maybe even a little bit above. Was the main question now is on timing. That's providing support today for now. We'll see if we get that announcement, or if not, when that comes. So this is Arlan Suderman again, wishing that you have a good weekend.